And thank you all for taking the time to meet with us here today. Thank you for the Cotton Board for setting everything up. Certainly hope to be able to see all of you soon. For those of you who haven't had a chance to meet personally yet, my name is Jon Devine. I'm an economist with Cotton Incorporated. I've been doing that for the past 12 years. I primarily work with the retail end, so if my face isn't familiar, that may be a part of the reason why. But when I do meet, with the downstream folks, I share with them the same types of information I share with you guys, with the primary focus being on the cotton market and also, what may be going on with cotton prices. So with that, we'll go ahead and get started. I'm going to see if I can get my screen shared over with you guys without any issues. Is that looking okay? If somebody has their microphone on, it's all good? Okay. All right. So before anybody's coffee gets cold, we'll go ahead and get rolling. Just in terms of general setup, I had the presentation organized to go from most general to more zoomed in on the cotton market. So as you all are all very aware, the most macro or the most big picture event that has been affecting all of us here in the U.S. and also around the world, of course, has been COVID. It's talked on the news every day, but I think something that doesn't get shown often enough is just a chart of what's happening with COVID. So I'm showing you here our data from that famous Johns Hopkins website. These are new daily cases. So these are new diagnoses around the world. And what's very unfortunate is that we have yet to see that line turn negative. We did see it plateau back in April, but then we saw near exponential increases throughout May and June. Looks like we have reached another plateau, and hopefully we finally will start to see that move a little bit lower. And of course, one of the reasons why COVID gets so much interest because it has had huge impacts on global economic growth. Once again, working from most general down to the cotton market. The most general economic statistic that's available to us is that for global GDP. What I'm showing you here are forecasts for global GDP that were issued at different periods in time. So that gray bar for January, showing that plus 3%, that was the IMF's estimate just before the COVID virus hit. In April, when we did see that time period leading up to that first plateau in cases, we saw them reverse their expectations. Instead of going to plus 3, they went to negative 3. Then their most recent estimate released just a month or two ago in June is calling for a 5% decline in overall economic activity relative to where we were in 2019. This is expected to be the worst economic contraction we've had since World War II. So these are very big numbers. When we're dealing with numbers like this, it's always helpful to have some context. Just a little bit of context to throw at you guys if you want to take a look at the worst recession that we experienced recently back in 2009. That was only a decline of 1/10 of 1 percentage point. So take a look at where we are here in the current calendar year. We're looking at a decrease in economic activity that's about 50 times worse than it was in 2009. So a real serious situation that we're in because of COVID, and that's led to a serious situation that we're facing economically. Something else I want to point out with COVID is that it has hit different parts of the world at different times. Of course, we're all aware that China was the first to be affected by COVID. There are a lot of questions in terms of the case numbers there. I think we can expect the actual number to be a good bit higher than what they're officially reporting. But I want to show you just the size of the peak that occurred in China and also the timing of the peak that occurred in China relative to everywhere else. So China's peak occurred in February. The next major epicenter for the virus was in Europe. We saw that start to really peak up in the second half of March and into April. A little bit later, we saw things start to take off in the U.S. We did have a handle on things, but unfortunately, they got a little bit out of control on us there once we got into June. And then just for some further comparisons, you can take a look at what's been happening in Latin America. Latin America, in terms of their total, in terms of their daily caseloads, similar to what we're seeing here in the U.S. Once again, a reason why I'm dragging you through all this is just to highlight the timing that's been occurring in different regions. That timing is important because it gives an idea to look at, what the consequences of the virus have been, given that the wave has already crested in some areas, and gives an idea of what we can expect once we get through to the other side. And we can also start thinking about some of the consequences associated with COVID. So early on, back in February, March time period when China was getting hit the heaviest by COVID, what we saw was a lot of the world's factories shut down. This caused a lot of supply squeezes throughout the apparel supply chains. Even if companies weren't sourcing their garments from China, they're probably getting garment components, things like buttons and zippers. And the slowdown or shutdown in China, it was a lot harder to get goods manufactured than it normally was. Once we move on from the supply shock, of course, there's a demand shock. If stores aren't open, and particularly if they don't have established online channels, they're unable to sell. So you take a look at some statistics related to clothing store sales around the world. Of course, they're pretty dramatic when you consider the fact they weren't open and weren't able to sell anything for a period of 2 or 3 months. And then, once we get beyond the wave, we do see things starting to reopen. But when things reopen, we're not all the way back to normal. We think about fear. It's not necessarily a switch that you can turn on and off. People were scared to go out because of COVID. Even though things may be looking better in certain areas, consumers may or may not be ready to go back and restart their lives the way they did before. They may not be ready to go back and spend the way that they did before. Of course, going out and seeing masks out there is a reminder of that. We still need to be careful. COVID still is out there, and that may help keep people at home. So once again, to point some of this discussions, talk about the timing, how we've seen some of the effects, when we see some of those effects, and what we may see in terms of recovery once we get beyond that. So to do that, we can take a closer look at some data associated with consumer spending or consumer behavior. The numbers going to be thrown at you are year-over-year changes. We'll start by taking a look at China, who of course was the first one hit by the virus. Take a look at the year-over-year change in total spending in China. Pretty severe reduction there in February. We do remember that we are talking about China, which has been a major motor for global economic growth over the past couple of decades. Typically, if you look at their spending numbers, they're up 10% year over year. So the reversal from plus 10 to minus 20, representing a very sharp contraction there. The good news is those times gone on, they've got further away from their peak in terms of shutdown, or their peak in terms of caseloads. The numbers have gotten less negative. The latest data we have available showing just a minus 1% change year over year. But once again, we got to remember we're comparing this against 10% growth. So better, but not back to normal, not yet, even in China. We can take a look at what's been going on in terms of clothing spending too. Take a look at clothing. We've seen the pullback in China and also in other markets be more steep than what we've seen in terms of overall spending. Clothing is somewhat discretionary. There are some items that need to be replaced. Like I hope all of you are buying new underwear when you need to. But there are some other garments that are a little bit more discretionary, like our fashion items. You can put off that dress shirt potentially for another few months or maybe a year or so if you need to. And that's one of the reasons why the decreases in clothing spending have been more steep than what we've seen in terms of overall spending. So that's what's been going on in China. We've also pulled data here for Europe, who peaked a little bit earlier than us, and then, of course, our own statistics as well. Take a look at both Europe and ourselves. We bottomed out with about a 20% decrease year over year in April. Europe's decrease is a little bit deeper than ours. But they've been able to take themselves out a little bit sooner. Something that's a little bit encouraging, you take a look at European spending numbers for June. They're actually positive compared to where they were a year ago. So things on the right track in Europe, and I think they will get back on track here in the U.S. as we get a little bit further down the road. But right now we're taking a look at terms of the shape of our declines. We were a little bit shallower than Europe, but we still have a little bit ways to go in terms of our increases. want to take a look at the spending numbers, something you guys have probably already caught on, but the colors of these arrows, the darker the blue means the steeper the decline. And unfortunately, you take a look at European apparel spending, still very negative, still down about 30% relative to where they were in 2019. But of course, negative 30% is a lot better than negative 80%. So some really eye-popping numbers you're seeing here. Things are getting better, but we still got ways to go. Something encouraging in the U.S., you take a look at the numbers here for June. This is one of those situations where I had to go back and triple check the figures because it's really not so bad. Minus 2% year over year, given the fact that, we are still seeing some resurgence in COVID, particularly in June. Is somewhat encouraging. So we are on the right track in terms of clothing spending in the U.S. Hopefully things will continue to improve. But of course, we do have this increase in COVID cases that may pull spending back over the next month or two. So a challenging situation, but there is some recovery in the pipeline. The further out we get and the more that we can get COVID under control, the better we'll probably be. But something I do want to highlight here as well, you take a look at these dark blue numbers, particularly, for the apparel spending, very steep and also a very sudden onset. So if you guys can put on your retailer hats and think about, the situation they've been facing, I don't think anybody was predicting COVID to be as severe as it was, and certainly weren't expecting it to be as quick in terms of its onset as it was. So what happened is that retailers got saddled with a lot of inventory. So this is what a wall of apparel looks like. In picture terms, this is what it looks like in chart terms. The U.S. government, one of the data points that they put out associated with retail sales is an inventory sales ratio. As the name implies, it's just the value of inventory over the value of sales every given month. And if you take a look at that number, what really stands out is the figure for April. In April, that inventory sales ratio was up around 18%. That's about 7 times the average. So the sudden pullback in spending with orders still trickling in meant a huge accumulation of inventory. Of course, it's not great for your finances to be sitting on a lot of expensive product if you're not able to sell it. So this is highlighting some of the challenges that our retailers are facing from a financial perspective. Some of the reasons why you've seen a lot of retailers go into bankruptcy, and also why you're seeing a lot of stores closed among those that are even staying open in operation. Fortunately, we have seen some improvement and some very sharp improvement in that inventory sales ratio. A lot of that's due to the improvement in sales that we've seen here in recent months, but that ratio value is still up about 50% compared to where it was pre-COVID. So retailers still have their hands full in terms of trying to get some of that product moved and try to do something to improve their financial position. Now, as you could think, if you guys were sitting on a lot of inventory, one way you may try and encourage consumers to get out there and spend some money is to put things on sale. There have been a lot of sales out there. One way you can track the movement in prices is through the CPI. For clothing, you take a look at the CPI for clothing. We saw the steepest monthly drops on record. Current clothing prices here in the U.S. are at their lowest values that we've seen since the 1980s. So we've had about 40 or 50 years of any price increases wiped out just over the past couple months due to COVID. We've already talked about the sales volumes decreasing in terms of consumer spending. Here you can see the price per garment. So it's like not only are retailers selling fewer garments, but the garments they are selling, they're having to try and move them at lower prices. So margins are pinched. Once again, underlining the tough financial situation that a lot of our apparel sellers are facing right now. One way that they've been able to try and improve their financial situation is to decrease their orders. So in the chart on the left, I'm showing you U.S. clothing imports. This is on a weight basis. So you can think roughly this is what's going on in terms of bales coming into the U.S. in apparel form. What you see is we have very steep declines since COVID. Collectively, we're down about 50% year over year relative to the import volumes we've collected over the past 3 months of data. So some pretty significant declines occurring. But something else that's important to point out is that we've had decreases in apparel imports even before COVID took place. We started implementing higher tariffs on Chinese-made apparel beginning in September. When you think about sourcing that was occurring in China, retailers were choosing to buy from China because it was their cheapest option. The tariffs changed that math. And since they changed what was their cheapest or preferred option, that meant some effect on their financial situation. It did mean a pullback in orders across the board. So pre-COVID, in those months when we had tariffs before COVID really started to hit, which was September to February, we saw U.S. apparel imports down about 10% in total year over year due to the effects associated with tariffs. You may want to take a look at what was going on specifically with China. You take a look at the decreases in China from September through February. Declines were steeper than what we saw overall, which is what you'd expect. They've been down about 20-25% year over year. Of course, things got a little bit worse once COVID hit. But if you compare the numbers for China post-COVID relative to our global numbers, they're essentially in the same ballpark. So what we're seeing is the decrease in Chinese share of U.S. apparel imports. It appears to have stabilized. Some of that may be due to supply chain issues. Some of the other markets which potentially could be providing us with apparel, like Latin America, they continue to be hit very hard by COVID. While China has moved beyond COVID in terms of its supply chain effects, their factories are open. They're able to continue to supply, and that may be something that's preventing further erosion in Chinese market share. But point of all this is that it adds up. So we're starting to narrow our focus back to the cotton market. And we've gone from some of our very macro figures all the way to yarn fiber demand that we're taking a look at here. What I'm showing you here in this chart, the green bars, is global production estimates issued by the USDA at different points in time. You can compare the forecasts in January for the crop year that just ended relative to where they were in August. You can see the crop got a little bit bigger, but of course what stands out is the 20 million bale reduction that we had in mill use. That 20 million bale reduction in mill use forecast resulted in a 20 million bale increase in ending stocks. We're expected to start, when we did start this new crop year, with the second highest volume of cotton in storage than we've ever had. We're second only to some of the years after the price spike, when high prices encouraged acres and decreased consumption. Take a look at forecasts for the 2021 crop year. We are expected to have another slight surplus. A lot of growers around the world already had cotton locked in as their choice. Also, all ag prices have been affected by the coronavirus. So, cotton, it's not maybe offering the profitability that we'd like, but a lot of other crops are in the same boat. USDA is forecasting a pretty strong increase in mill use. That's built on expectations of a rebound in GDP, particularly as we get deeper into the 2020 crop year and into the 2021 calendar year. We'll see whether or not that may or may not be realistic. But even with what could be considered a somewhat aggressive assumption regarding growth in mill use, we are expected to have another surplus in the coming year, meaning another addition to ending stocks, meaning that there will be plenty of cotton supply out there, which could make it a tough price environment for some time to come. Take a little bit closer look at the U.S. Supply and demand outlook. Here, the light blue bars are our production forecasts. Dark blue bars are demand, which is mill use plus exports. Parallel to what we saw at the global level, you can see how there's a huge change between our January numbers and our latest numbers. Of course, COVID driving that in terms of its effects. Mill use, we're expected to have an increase of ending stocks of a couple million bales from the old crop into new crop. And also, once we get into new crop, we're expected to see another slight surplus. So once again, a lot of supply at the world level, a lot of supply here in the U.S. could make things a little bit challenging for prices. But there is a lot of uncertainty surrounding these numbers. We already touched on that. We've had some back and forth on new crop numbers already. You take a look at the July figures from the USDA. We did see planted acreage and production lower our production estimates relatively significantly. And here are the numbers that just came out last week. We did see an increase in abandonment forecast. I know some of you guys out there in West Texas are suffering very dry conditions. Then we also had that hurricane take out some acreage down in South Texas. So that last USDA report took about 1 million harvested acres out of production, but yield forecasts were up. and that led to production forecast increase in August relative to where we were in July. So a lot of moving around in U.S. crop numbers. Seeing this movement on the supply side, I think we'll continue to see movement in forecasts on the demand side, given the uncertainty associated with COVID. The bottom line for us, we want to take a look at our stock levels. So take a look at, the surplus. This means the additions and subtractions we may be having relative to ending stocks. But the bottom line for ending stocks is that we're going to have pretty high stocks here in the U.S. We're going to have high stocks around the world. The question is, how well are we going to be able to move that cotton? And for here, us in the U.S., we export 85% of our crop every year. So a lot of questions are centered on exports. When we just start a new crop year, we roll over any of our undelivered export sales. And some good news there, particularly given how challenging the overall economic environment is that our export commitment right now is only down 15% relative to last year. So demand has held up pretty well, at least in terms of the number of the contracts that we have signed for export delivery. Of course, what we want to see is all those contracts materialize in terms of physical shipments. And, as always, there are some questions about whether or not that will happen. In particular, there may be some questions about whether or not that will happen given the fact that we've been selling a lot of our cotton to China over the past couple months. That phase one agreement did result in increases in sales to China. And since COVID really started to lock down the world, we've seen China be the dominant buyer of our cotton. From April through the end of the crop year, China represented 70% of all of our export sales. So China's been making purchases everywhere else. Essentially, it's been crickets for the past few months. And things have gotten a little bit more tricky with China here recently as well. So we'll see what may happen with phase one. And once again, whether or not those contracts will get turned into physical shipments. As you're well aware, we have been ramping up some of our tensions with China. Some of that is related to the Hong Kong protests and us, not agreeing with the crackdown that China has been enforcing in Hong Kong. Some developments there just over the past couple of weeks. U.S. now requires anything made in Hong Kong to have a made in China label. There's somewhat consequential there in terms that it is part of the tensions between U.S. and China. But we don't get a lot of apparel from Hong Kong, so not necessarily a tremendous issue. What Hong Kong does have is a lot of apparel sourcing. That's why Cotton Incorporated has an office there. Something to watch is if the U.S. government puts sanctions on financial transactions out of Hong Kong or starts treating Hong Kong from a financial standpoint like the rest of China, that could make sourcing or could challenge China's role as a sourcing hub, Hong Kong's role as a sourcing hub. Something else associated with China and tensions more recently is the Xinjiang issue. I'm not sure if you may or may not have heard of that. But Xinjiang is a province in China located in the extreme northwestern part of the country. Ethnically, it's very similar to other countries in Central Asia. So I think the stands. It's primarily Muslim region. And there has been some tensions there with China that have been boiling up over the past couple of decades. So this is what traditionally things look like in Xinjiang. This is what the capital in Xinjiang looks like right now. Over the past couple of decades, the Chinese government has been working on integration policies in Xinjiang to try and make them more Chinese, to bring them more into the fold of the greater Chinese country. Not all of the population out there in Xinjiang has been happy with that. There was some violence in the 90s through the 2000s. And all that seemed to really come to a head somewhere around 2010 when the Chinese government became much more aggressive with Xinjiang. It has had re-education camps. There's unprecedented surveillance in the Xinjiang region. Some things even such as forced birth control occurring in that area. And that's prompted the U.S. To respond. So by this point, you may be asking, what does this matter for us? What does this matter for cotton? It matters because Xinjiang also is very heavy cotton. Xinjiang province, you do have the largest scale and the most high-tech cotton farms in China located in that province. In recent crop years, Xinjiang represented about 90% of Chinese cotton production. China is the world's second largest cotton producer, so it represents about 1/5, one of every 5 bales grown out around the world. And something that's important relative to the tensions in Xinjiang or in China is that at the end of July, the U.S. put a major group responsible for cotton production in Xinjiang, known as the Xinjiang Production and Construction Corps. It's a quasi-military group that's been doing farming out there since the 1950s. They listed them as a sanctions or as a human rights abuser, which means they are subject to sanctions. So this means that any U.S. company that handles Xinjiang cotton can be subjected to a U.S. A fine from the U.S. Department of Treasury. In addition to the cotton growing operations, the XPCC also generates a lot of power in the region, operates a lot of mills and ginning operations in the region, and also provides a lot of electricity out in the region. So when you take a look at the effects of this production core being listed as a violator of human rights, it's going to have widespread implications in terms of what sourcing U.S. Retailers may be able to do from China, because Xinjiang cotton flows to a lot of the rest of the country. And it's going to be very hard for retailers and brands to prove that they're not using any cotton from Xinjiang. So an escalation of tensions also could potentially impact, our export sales as well, given that we have been dependent on China here in recent months. But to sort of bring everything together, we do have a lot of fiber supply out there in the world right now. Really would be helpful if we could get beyond COVID and start getting a demand motor going into a higher gear. There is inventory throughout supply chains that we're going to need to clear until we start feeling that real strong tug from demand once it starts to surface. So unfortunately, there may be a little bit of lag there due to inventory accumulation. Trade tensions with China have been escalating, as we touched on. Something to watch for prices is if the phase one deal may or may not be in play. There have been reports of some merchants buying some cotton on the cheap in India, where they may potentially be looking to sell some of that cotton into China. So maybe facing some price competition from other markets, given the tensions and some of the other issues that are all floating around in the market right now beyond the COVID situation itself. So with that, those are my thoughts on the market. Hopefully kept you all awake early in the morning. Hope you guys all had some strong coffee to get you through the charts. Any questions or comments? I welcome.